To my fellow students and to you, sir, good afternoon. I am Julia, your presenter for banking theories. And so there are three banking theories, so namely the commercial bank theory, shiftability theory, and the anticipated income theory. The first theory is the commercial loan theory. The commercial loan theory states that the commercial bank should only forward short-term loans, self-liquidating loans, and the commercial paper. So this means that banks should only lend money for productive loans to business organizations. Short-term loans is a loan maturing in less than 1 year. A short-term loan is a credit facility extended to individuals and entities to finance a shortage of cash. Examples include credit card, bank overdraft, and trade credit. This makes it possible to buy goods or services from a supplier on credit rather than paying cash upfront. A short-term loan works as a rescue when people need some money urgently. For example, a business cannot finance its daily orders if all its debtors are delaying payments. Banks, credit unions, and financial institutions provide many short-term lending facilities to businesses to cover their everyday costs. One can get a short-term loan from banks, financial institutions, and suppliers. Then, the self-liquidating loans, which means that the loan itself generates the funds necessary to pay it off. For example, a seasonal business obtains a 100 peso loan to acquire inventory for its Christmas season. Once the inventory has been sold during the peak selling season, the resulting cash inflow is used to pay off the full amount of the loan. The repayment schedule and maturity of a self-liquidating loan are timed to coincide with the assets that are expected to produce income. These loans are intended to finance purchases that will quickly and reliably generate cash. A retail business might use a self-liquidating loan to purchase extra inventory in anticipation of holiday shopping seasons. The revenue generated from selling that inventory would then be used to repay the loan. Self-liquidating loans are not always a wise credit choice for businesses. Then, the commercial paper. Commercial paper refers to the debts that arise in the course of commerce, the processing, moving, and marketing of goods. Commercial paper is defined as a money market instrument that is used for obtaining short-term funding and is usually in form of a promissory note issued by investment-grade banks and corporations. Most commercial papers are easily rolled over by paying for old issuance from the proceeds of the new issuance. Hence, it becomes a continuous source of funding. The theory suggests that banks must be liquid, that if the commercial banks maintain a substantial amount of assets that can be shifted onto the other banks for cash without material loss in case of necessity, then there is no need to rely on maturities. Loan granted should be confined to financing the production of goods. In this way, loans have less risk because repayment will depend on the sales for goods, and loans will be self-liquidating because when goods are sold, collections will be used to pay the loans on banks. So there are certain advantages and disadvantages of this theory. So let's jump onto the advantages. These short-term self-liquidating productive loans acquire three advantages. First, they acquire liquidity so they automatically liquidate themselves. Second, as they mature in the short run and are for productive ambitions, there is no risk of them running into bad debts. Third, such loans are high on productivity and earn income for the banks. So, after these advantages, despite of all of the advantages, the commercial loan theory has certain defects. First, if a bank declines to grant a loan until the old loan is repaid, the disheartened borrower will have to minimize production, which will ultimately affect business activity. If all the banks pursue the same rule, this may result in reduction in the money supply and cost in the community. As a result, it makes it impossible for existing debtors to repay their loans in time. Then, the second one. The theory believes that loans are self-liquidating under normal economic circumstances. If there is depression, production, and trade deteriorate, and the debtor fails to repay the debt at maturity, then third, this theory disregards the fact that the liquidity of a bank relies on the saleability of its liquid assets and not on real trade bills. The bank assures safety, liquidity, and profitability. The bank need not depend on maturities in time of trouble. Fourth, the general demerit of this theory is that no loan is self-liquidating. A loan given to a retailer is not self-liquidating if the items purchased are not sold to consumers and stay with the retailer. In simple words, a loan to be successful engages a third party. In this case, the consumers are the third party besides the lender and the borrower. The shiftability theory, this said that the liquidity of the bank depends on its ability to shift its assets to someone else at a predictable price. Liquidity is a tantamount to shiftability. Bankers and banking institutions must be directed to investments as a source of bank liquidity, think loans. In banking, the shiftability theory is an approach to keeping banks liquid by encouraging the shifting of assets. When a bank has a shortage of ready money, it can repo or sell its assets to a bank that is more liquid. This approach lets the banking system move more efficiently with fewer reserves or investments in long-term assets. The shiftability, the shiftability has reduced the necessity of holding a reserve of a huge amount of idle cash balance. It has presented an alternative way of real bill doctrine theory where there is a possibility of risk because of economic depression in the case of buying and selling of commercial goods and raw material. With the help of the shiftability theory, the probability of income can be increased and the probability of risk can be reduced. The shiftability theory has positive elements of truth. Now, banks obtain sound assets which can be shifted onto other banks. Shares and debentures of large enterprises are welcomed as liquid assets accompanied by treasury bills and bills of exchange. This has motivated term lending by banks. This one has advantages and disadvantages. The advantages of the shiftability theory, it it's because it has a positive elements of truth. Now, banks obtain sound assets which can be shifted onto other banks. Shares and debentures of large enterprises are welcome as liquid assets accompanied by treasury bills and bills of exchange. This has motivated term lending by banks. Then the disadvantages is that shiftability theory has its own demerits. First, only shiftability of assets does not provide liquidity to the banking system. It completely relies on the economic conditions. Secondly, this theory neglects acute depression. The shares and debentures cannot be shifted to others by the banks. In such a situation, there are no buyers and all who possess them want to sell them. Third, a single bank may have shiftable assets in sufficient quantities, but if it tries to sell them when there is a run on the bank, it may adversely affect the entire banking system. Fourth, if all of the banks simultaneously start shifting their assets, it would it would have disastrous effects on both the lenders and the borrowers. Third theory is the anticipated income theory. This holds that there is no such thing as self-liquidating loans. Goods will not sell themselves, nor there are any guarantee that the goods will be as vulnerable tomorrow as they are today. This theory encourages banks to begin making long-term loans, consumer installment loans, and amortized real estate mortgage loans. This theory states that irrespective of the nature and feature of a borrower's business, the bank plans the liquidation of a term loan from the expected income of the borrower. A term loan is for a period exceeding 1 year and extending to a period less than 5 years. The bank puts limitations on the financial activities of the borrower while lending this loan. While lending a loan, the bank considers security along with the anticipated earnings of the borrower. So a loan by the bank gets repaid by the future earnings of the borrower in installments, rather giving a lump sum at the maturity of the loan. Advantages. This theory dominates the commercial loan theory and the shiftability theory as it satisfies three major objectives of liquidity, safety, and profitability. Liquidity is settled to the bank when the borrower saves and repays the loan regularly after a certain period of time in installments. It fulfills the safety principle as the bank permits a relying on good security as well as the ability of the borrower to repay the loan. The bank can use its excess reserves in lending term loan and is convinced of a regular income. Lastly, the term loan is a highly profitable for the business community which collects funds for medium terms. Disadvantages. The theory of anticipated income is not free from demerits. This theory is a method to examine a borrower's creditworthiness. It gives the bank conditions for examining the potential of a borrower to favorably repay a loan on time. It also fails to meet emergency cash requirements.